Hi, today let's talk about how the US Federal Reserve controls global life, even if you don't live in America. Whether you live in London, Lagos, Dubai, Sao Paulo, Mumbai, or Manila, the decisions of one institution, the US Federal Reserve, silently shape your economy, your currency, your job opportunities, and even the prices you see every day at the grocery store. Most people wonder, why should a central bank in Washington, D.C. have the power to affect my life thousands of miles away? Today, we're diving deep into the global mechanics behind the Federal Reserve's interest rate decisions, and how their ripple effects touch the wallets, dreams, and daily stability of billions of people around the world. This is the hidden architecture of global finance, explained simply but powerfully. To understand the Federal Reserve's global influence, we must begin with the US dollar, the world's dominant reserve currency. More than 80% of global trade is invoiced in dollars. Over 60% of central bank reserves are held in dollars. Oil, gold, wheat, iron ore, semiconductors, all priced in dollars. This wasn't accidental. After World War II, the US became the world's economic anchor and the dollar became global money. Here's why that matters. When the Federal Reserve raises interest rates, the value of the dollar rises. A rising dollar means other currencies weaken, imports become more expensive. Everything priced in dollars, from fuel to food, suddenly costs more. So people in South Africa, India, Egypt, Philippines, or Brazil feel the pain instantly. A grocery store in Nairobi paying for imported wheat in dollars, a gas station in India buying oil in dollars, a tech company in Europe purchasing chips priced in dollars. All these prices rise. Not because of local decisions, but because the Fed made borrowing dollars more attractive. This is economic gravity, impossible to escape. The second mechanism is global capital flow, essentially where investors around the world choose to put their money. Investors chase returns. They compare interest rates across countries. And when the Federal Reserve raises rates, US bonds suddenly become safer and more profitable. So what happens? Money exits emerging markets fast. Funds flow out of Indonesia, South Africa, Mexico, Turkey, Argentina, Malaysia, Thailand, Eastern Europe, even Gulf equity markets, and rush into US Treasury bonds, US stocks, US money markets. This triggers something economists call capital flight. Real-world effects for local people. Stock markets fall. Local currencies lose value. Banks tighten lending, businesses pause investment. Unemployment quietly starts to rise. This is not theory. This happens repeatedly. In 2013, when the Fed hinted it would raise rates, the taper tantrum, currencies in India, Brazil, Turkey, and Indonesia collapsed within days. Tens of millions of people saw the purchasing power of their salaries fall before the Fed even implemented the rate hike. This is the power of expectation in global finance. One of the biggest reasons the Fed influences global life is that much of the world borrows in US dollars. Governments do it, banks do it, corporations do it. Why? Because US dollars are easier to borrow, cheaper, and more trusted by international investors. But this creates a huge vulnerability. When the Fed raises rates, the dollar strengthens. When the dollar strengthens, dollar debt becomes crushing. Picture this. A real estate company in Turkey borrows 100 million. At the time, $1 sako 4 lira. So their debt sako 400 million lira. After the Fed hikes, the dollar strengthens. Suddenly, $1 sako 32 lira. Their debt sako 3.2 billion lira. Same loan, same principal, but 8 times more expensive to repay. This is how companies go bankrupt. This is how governments fall into crisis. This is how ordinary people lose their jobs. History proves it. Mexico crisis, 1994. Asian financial crisis, 1997. Argentina, 2001, 2018, 2023. Turkey 2018 present, Sri Lanka 2022. Behind almost every major emerging market meltdown lies the same formula: dollar debt plus Fed tightening shark crisis. And who suffers most? Not the politicians or bankers, but the everyday citizens whose savings evaporate and whose prices skyrocket. Nearly all major commodities are priced in US dollars. Oil, gas, coal, gold, wheat, soybeans, copper, steel, coffee. So when the Fed raises rates and the dollar strengthens, oil becomes more expensive in local currencies. Food prices rise. Transportation and logistics costs increase, electricity bills surge. Think about the chain reaction: higher dollar, higher oil cost, higher transport cost, higher food price, higher living cost. A Fed decision in Washington can make onions, bread, and rice more expensive in Egypt. It can make electricity pricier in Bangladesh or Pakistan. It can raise construction costs in the UAE or Malaysia. Global inflation often begins in the corridors of the Federal Reserve. The Federal Reserve isn't just another central bank. It is the anchor of the global monetary system. When it raises rates, other central banks face a painful choice: raise their own rates to defend their currency, or watch inflation and capital flight destroy their economy. Countries like the UK, South Korea, Singapore, Gulf states, pegged to USD, Nigeria, India, the Philippines, all must respond, even if their domestic economy is weak. This means higher mortgage rates, higher car loan interest, slower business expansion, tighter lending from banks, reduced consumer spending. Even if your country isn't growing or doesn't need rate hikes, the Fed pressures your central bank to follow anyway. This is global monetary diplomacy, and the Fed sits at the head of the table. Believe it or not, the Fed's words are as powerful as its actions. Markets react instantly to tone body language. Phrases like higher for longer or data dependent, even a single sentence can wipe out or create trillions of dollars in global wealth. This affects pension funds, sovereign wealth funds, corporate investment plans, mortgage rates, startup funding, consumer confidence. A Fed speech can slow hiring in Dubai, freeze real estate markets in Singapore, increase food inflation in Kenya, or send shockwaves through Latin America. That's how psychologically central the Federal Reserve has become. So how does all this theory translate into real life? A Fed rate hike can increase your rent, reduce your job opportunities, make groceries more expensive, slow your salary growth, increase your mortgage payments, reduce your country's economic stability. Your daily life is tied to the Fed because the global economy is tied to the dollar. You may never visit the United States, but US monetary policy visits you every day through prices, loans, exchange rates, and economic stability. The Federal Reserve is not just America's central bank. It is the central bank of the world, for better or worse. Its decisions set the tempo of global financial life, influencing governments, shaping markets, and touching billions of ordinary people. Understanding this isn't just economics. It's understanding the invisible system that guides our financial destiny. If you want to understand your world, start by understanding the Fed.